but today we're talking about building your long-term portfolio. And I've got a lot of slides. So let me just jump right in and share my screen. We've got a lot of slides here. I will provide the slides to you after the webinar, along with a replay. They will come to you on Tuesday of next week. If you want them sooner, just send me an email and I'll make that happen. Who am I? My name is Joe Morgan. I'm a CFA, a CFP, and I work with women and families who are looking to get rid of financial anxiety. They're ready to do long-term financial planning and really live intentionally in their life. And that's why my tagline is what it is: clarity. We have to have clarity first around our current situation, then we can get control, and only then can we live truly with intention. And I had to share a photo of the new addition to our family. That's our standard poodle, Charlotte, who joined us recently. And she's been a lot of fun and a lot of work, as some of you may know. Just a quick disclaimer here. This is not financial advice. Financial advice is specific to you and your situation. I can only give financial advice to my clients because I know them well. I don't know you. What we're doing here is we're just talking about general money moves, things that might be appropriate for you or might not. And I have recorded a couple of other webinars. They're available if you're interested. Let me know, and I can send you a link. So let's get into it. What is financial planning? This is how I view financial planning. You want to build your best financial life, not the best financial life, but the best financial life that you can attain given what you want to do and what your resources are. We get there by building these 4 columns in an appropriate way. We want to protect what we have. We want to know where it goes. That's the spending. We want to make it grow. That's the investments. That's what we're going to be talking about today. And we want to have independence and dignity in our long life. We want to make sure we're not living off of our kids. So we want to plan for all of our expenses throughout our years. And if we do this with intention and purposeful effort, we can get there. The investment side is often confused or assumed to be all of financial planning. Like if you just have the best portfolio, then everything else takes care of itself. And that is absolutely not true. What you're looking at here is the process I go through with clients. And I just want you to note how far down the list investments are. We don't get to investments until we're 4, 5, 6 months into a relationship. Investments are only there to support the plan that we build. The plan is the most important thing, not the investments. When we talk about a long-term portfolio, what does that mean? Well, long-term means, the way I'm defining it, is that all funds that we plan to spend 5 years or more into the future. If you have money you plan to spend within 5 years, probably the best thing to do is to put it in a savings account and forget about it. Your objective with that money is not to make it grow and earn more money. Your objective is to make sure it's available to you so that you can spend it on what you want to spend it on. So long-term portfolio means 5 years plus. And we do this because we can't predict how investments are going to go in the short term unless they're very safe. And that's why I mentioned the savings account for short-term funds. Now, what's magic about 5 years? Well, there's nothing magic. It's just a number I picked. And I have some clients who want to do more than that, and some that do less, as long as they understand the risks involved. But what you're looking at here is the S&P 500, the largest 500 stocks in the US, going back nearly 100 years. And the question is, when they drop, how long does it take you to recover the losses that you made? And 87% of the time, you will have recovered your losses within 5 years. That's not 100%, but it is 87%. And if you want to go to 3 years, you're 84%, 1 year, 75%. In other words, the market goes up 3 years out of 4. But over the long term, they've never gone down. How do I know that? Well, when we hit an all-time high, that's what it means. This market is higher than it's ever been. So if you bought any time in the past, you're up. This is not really the way most people think when they invest. The way most people invest is they try to predict the future, they act on impulse, all of these things you see on the screen. I'm not going to read them all, but they basically don't have a plan. They don't have an anchor. And so they're driven by their emotions. Optimism on the way up, elation at the top. And elation, you think they're selling at the top when they're elated? Probably not. Then nervousness as they start to go down, and fear at the bottom. Do you think they're buying in the middle of fear at the bottom? Probably not. So we tend to do the opposite of what we say we should do, which is sell high and buy low. We tend to actually sell low and buy high. And that's because we let our emotions drive us. And so the way around this, the way that I get around this with my clients is to have an investment philosophy, a good solid investment philosophy that we can lean on when times are really good and we're feeling really elated, and when times are really bad, when the markets are down. And so what is a good investment philosophy? Well, it's got to be something that's true in all seasons, at all times, throughout market cycles, economic cycles, what have you. It also has to lead to something that's actually executable in a portfolio, something we can actually act on, right? And so what I want to talk about in the next few slides is the thinking behind my investment philosophy, and I'll lead you to exactly what it is. So I find this very interesting, and I find it to be very true, I believe. The wisdom of the crowd. Some of you may have heard of this. There's a famous book a few years ago by that title. But the first documented instance of this was in 1906. This statistician, Francis Galton, in the UK, went to a farmer's fair. And at the farmer's fair, there was somebody offering a free ox if you could guess the weight. And there were 800 guesses, and the range was huge, but the average was almost exactly the right weight. The ox weighed 1,198 pounds, and the average was 1197. The average was actually closer to the actual weight than the winner. The winner, I believe, was 5 or 6 pounds off. So very interesting to know that you take the wisdom of all the people who showed up to take a guess, and you take the average, and it was correct. And this happens over and over again. This is some data from an event, a financial advisor event that somebody did several years ago. You know, you have those jars of jelly beans. You ask people how to guess how many. Same idea as the ox. Well, this financial advisor got a range from 409 to 5,365. That's quite a wide range of guesses. But the average was 1,653, and the actual was 1,670. So again, the wisdom of all of those people averages in. If we have enough activity and enough people making guesses, then the average is typically right on par. Well, what the heck does this have to do with investing? Well, if we look at how the stock market works, every day there's about $440 billion traded in world equity trading volume, meaning every day if you take the buyers and the sellers and you add up all those transactions, $440 billion pushing stock prices up and down and around. So it's the same idea as people guessing the number of jelly beans, right? These people are guessing that the stock will go up or stock will go down. Now, are they right? Now, certainly you've got the wide range of opinions, and most everybody ends up being wrong in some sense. But the average overall, I think we can assume is about right. And so this is, the idea behind this is called efficient markets. And really the idea is that all the outstanding information that would affect the stock price is contained in that stock price, because you've got all these people pushing the price around, doing all this trading. So there's no way that you or I, or even a professional money manager out there managing billions of dollars, can go out against $440 billion trading every day and outsmart it. And that's true. That's been proven in academic studies as well, that no manager outperforms the markets over time. Certainly they can at times, but you can't predict when or who will do that. So a basic part of my philosophy is that you can't beat the markets. You can't guess to beat the market. So what is the philosophy? Well, it's basically these 3 bullet points. So human beings are designed to interconnect with each other. Since the first 2 cavemen got together and one said, I'll hunt and you fish, and we'll share resources, those connections have been growing. And no time, we don't feel it no time like the present here in this COVID times when we're having a hard time physically connecting, but we're spending a lot of time on Zoom and on the phone connecting with each other. So humans are designed to connect, and that's a growth activity on and on into the future. Companies are designed to stand in between those connections, enable those connections, and scrape off a piece of profit. So if we can't predict which companies are going to do well and which stocks are going to do well, but we know that as a group they're all going to do well, let's just own them all. Okay, a little bit simplistic, I understand, but let's do that. Let's own every public company out there, you know, adjusting for the cost to get us there, right? We don't want to spend too much money in fees and transaction costs to get every company, but let's put together a portfolio that basically holds every company, and we will, our portfolio, our retirement, our long-term funds will grow with that human activity over time, which we believe is on a long-term trend upward slope since the beginning of time, really. So what does this require? Well, there's three principles. You have to have a faith in the future. You have to believe that things get better when they go bad. But you don't have to know when they're going to get better. You don't have to know how they're going to get better. And you just have to believe that they will get better. The other thing you have to have is discipline to stay in the strategy. And I'm going to talk a little bit more about that in a moment. On the portfolio side, what do? Well, we have to have the right asset allocation that we can survive with. And we've got to have diversification within those asset classes so that we don't get killed by any one of our investments. And then, of course, there's ongoing management, rebalancing and such. So that's the philosophy. That's what I believe in. Let's talk about the Achilles heel to this philosophy, because there is one. And here it is. Here's how we lose. By structuring a portfolio where we can't live with it when the market crashes. Simple as that. If the market crashes and we see our portfolio going down, 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 and it goes so far down, remember you're getting hit with all this negative news, that you lose that faith in the future. If we do that, you're likely to sell out of the portfolio, and then you are lost at sea. And that is the danger to this strategy. But that's why, you know, we have a lot of coaching through that. So what you're looking at here is 6-month returns of a conservative investment strategy. And if we look here, you can see this is 2008, 2009, these very low returns. And if we were experiencing this, and if this was too much for us to take a 28% drop in the value, if we just couldn't take it and we sold out, look what we missed that happened right after it. All those positive returns almost always happen right after the negative returns. In fact, earlier this year, I have a note here on the right-hand side, we experienced the worst 35 days in the market ever, percentage-wise, not points, but percentage, ever. And right after that, we had the best 50 days ever. And that's not unusual. So we have to be able to survive those down dips. And it's very important because they happen all the time. Here we have a chart of annual returns of stocks going back. We've got, you see last year, the market was up 29%. This is through June 30th of this year, the market's down -4%. But what I want you to focus on are these red numbers. What these red numbers show you is during the year, how bad was it? What was the worst point of the market? So this year, we're only down 4%, but we were at one point down 34%, right? We all remember that, I'm sure. Last year, the market was up 29%, but at one point it was down 7%. Previously -20 and on back. You see, these numbers are not small. In fact, if you average these, going all the way back to 1926, you'll get about -14%, meaning an average year, the market will drop by about 14%. So we have to structure a portfolio that we can survive that, because that's going to happen every year. Now, why do we do that? Well, because, of course, the long-term trend is upward movement. Stocks go up over the long run, again, tied to all of this activity that we were talking about. And they go up to offset all of that volatility. But again, you've got to survive the downside. So let me give you some real numbers. If you were born January 1st, 1970, you are 50 years old. The S&P 500, the day you were born, was at 44. And today is at 3,258, or a couple of days ago when I put together these slides anyways. So if you had $10,000 gifted to you on the day you were born, put it in the markets, never touched it, never looked at it, didn't do anything, had it in maybe a deferred account where you didn't pay taxes, that would today be worth about $1.5 million. That's a 10% annual rate of return. And if we look at some other things that people sometimes consider investing in, like real estate or gold and inflation, you can see those returns are much lower, 3-4%. Now, not all real estate is 4%, right? Some real estate does better and some does worse, But now you're getting into the skill set. Can you pick the right real estate that's going to do better going forward? With stocks, you don't have to do that because you're owning all the stocks and you're just believing in that human interaction. So in summary of the investment philosophy, it's important to have a strong investment philosophy. It's important to have a diversified portfolio that is implemented in such a way that you can survive the downturn. But in reality, your success long-term is going to come from the planning you do that portfolio is supporting. The planning is the most important because there's other things besides the investments. There's spending, there's earnings, there's all of those other things, insurance, protection, all of those things that are going to make you financially successful. Let's solve the portfolio problem, put it to rest, and focus on the planning where we can really move the needle on our success. Now, I'm going to get in a little bit more specifics. I promised this in some of the lead up to the webinar, and just doing a time check. I've only got 3 minutes left. I'm going to go over. Sorry about that. Possible portfolios. So these are self-managed portfolios that I actually recommend to my clients depending on their risk tolerance. And you can see there's only 3 mutual funds in them. All 3 Vanguard funds, a total stock market, which is total US stock market, total international, and then a bond fund. Whoops. And here's the allocations from very conservative to very aggressive, just right there, very simple. So defining the funds and implementing them is not the hard part. The hard part is, again, understanding what risk you can actually take and which one of these you should actually be in. Now, what we've accomplished here by doing this? Well, we've tied your long-term portfolio to the growth of human activity, as we talked about, and we've created an allocation that you can live with through normal markets, assuming we've picked the right mix. What are we missing? Well, we're missing that coaching that actually happens, right? When the markets are down and when the news is coming at you, oftentimes it's not good to trust ourselves to make our own decisions. Oftentimes it's good to have somebody who is a market professional who can help you interpret what's going on and how it affects your portfolio, and again, reproject those plans for you to understand, okay, if the market's really going to stay down here, what does that do to me in reality in terms of my spending lifetime? Maybe you're still okay. Maybe it's just a little bit worse. I don't know. But if you have that information, it'll help you survive those downturns much easier. And the other thing you're missing is the ongoing strategy and monitoring, making sure these funds are doing what they're supposed to be doing and all of that. So if we do one of these 3 funds, here's those 3 strategies in graph form. I just went back to 1999 here. If we started with a balance of 500,000 at that time, we would have about $1.8 million today. That's about a 6% growth rate. All 3 of these strategies over this period performed similarly. We should not expect that going forward. They did that. There's a technical thing that happened with interest rates coming down. Long story short, it's probably not going to work that way going forward. The aggressive will outperform the moderate will outperform the conservative. But again, the point here is, if we had stayed in and survived all these dips, we would be up about $1.3 million, total $1.8 million portfolio today. Now, I said these are the portfolios that I recommend to clients. I have clients who manage their own money, and I have clients where I manage the money. So that's the clients who manage their own money. In terms of when I manage the money, and this is actually my personal portfolio as well, this is the aggressive strategy. We were talking about conservative, then we showed all 3. Now we're talking about the aggressive. This is where all of my money is, basically. So again, large stocks, small stocks, international, emerging markets. So again, trying to cover the whole world, everything out there. A couple of different funds, right? Small cap and a micro cap. Sorry about that again. And then the percentages. These percentages come from me looking at historical data and really trying to optimize how much should be in each sector. You'll see that I use Vanguard funds and dimensional fund advisor funds. DFA funds have been around since the early 80s. They're about $500 billion in assets under management. They're very similar to index funds. They just tweak it a little bit to get outperformance in several different ways. You know, I just love those funds. They do a great job. So anyway, so if we're doing the managed aggressive versus the self-managed aggressive, remember that fund I give to a client, they go away and do, versus the one that I do. The DFA, you know, managed aggressive has done better. The 500,000, remember, turned into 1.8. For self-managed, it turned into 2.5 with the managed portfolio. So 7.9% annual return versus 6.2%. Either one of these would be fine, right? Whether you're in 6% or 8%, should be enough to fund your plan as long as you've done the planning to make sure that that's the case. Thanks so much.